contingency. I'm going to share my screen here. So I'm going to be walking through the financing contingency in the residential offer to purchase. It's very similar in the condo. It's just kind of broken down differently. The condo offer to purchase, I would imagine, will be updated soon so that it is very similar to the residential offer to purchase, which was just updated this year. So, but you can kind of take what you've learned here and apply it to the condo. So I actually pulled up an old pre-approval letter from like a past buyer client of mine, just to use for an example for today. So I would say that is like the biggest thing that's going to help you write your financing contingency in the offer. If you don't have a pre-approval letter from the buyer, it's like next to impossible to complete a financing contingency, because your buyer would just be guessing at what they may be able to get from the bank. And I'll say, even though a pre-approval letter is not required with an offer, it is certainly, I mean, in this market, I don't think I've ever written an offer without a pre-approval letter, because the listing agent is always or the seller is always going to want that accompanied with the offer. I know some agents who don't even work with buyers, like don't even start the showing process until their buyers have a pre-approval letter. Because otherwise it's just kind of could be a waste of your time. So this pre-approval letter is so important to have with the financing contingency. So financing contingency starts on page 5 of the residential offer to purchase. It's called the financing commitment contingency because it is contingent on the buyer getting loan commitment. Not necessarily getting that full financing, just kind of what we talked about in team meeting on Tuesday. The buyer can get loan commitment, but then still have conditions to get approval of from the underwriter in order to actually get the loan. So it's the loan commitment that this contingency is discussing. So it states that this offer is contingent upon the buyer being able to obtain a written blank first mortgage loan commitment. So in this blank line here, and it even tells you what goes in there, you're putting the loan type or a specific lender. So this can be conventional, FHA, VA, what is that loan type? And then you could even be really specific about which lender is giving that loan. So conventional loan from US Bank, conventional loan from Cross Country Mortgage, conventional FHA loan from whatever, Fairway Mortgage. So buyer can be as specific as they want in here. If they know they only want to work with one lender and only that lender, and if they can't get a loan from that lender, they're not going to work with any other lender, then put that specific lender in there. So for today's example, the loan type in my buyer's pre-approval letter says conventional. So I'm going to state that this is a conventional loan. And I'm also going to put an X in this box to acknowledge that the financing commitment contingency is a part of the offer. Then it goes on to say, so buyer is going to get a conventional first mortgage loan commitment as described below within blank days after acceptance. Really important to communicate with your lender, especially your buyer's lender, especially during this time we're in where banks are overwhelmed with requests, and it's maybe taking them longer to go through the underwriting process. I would say typically like 30 to 35 days is what I see in this box here, but you may want to consider longer deadlines. Your buyer's lender should be able to give you a pretty good idea of how long they need. To be safe though, you might want to gear towards more like the 35 to 40 day range. Especially like we talked about, I mentioned in team meeting on Tuesday, with everything that's happening right now with buyers' jobs, they don't want to be able to deliver loan commitment until kind of right before closing, and to protect them so that in the event they lose their job, they could hold off on delivering that loan commitment until they're closer to that closing date. Then it goes on to say the financing selected shall be in an amount of not less than blank for a term of not less than blank years. So this dollar amount here is the amount that the dollar amount the buyer needs from the bank. So essentially it's the purchase price minus their down payment. Some pre-approvals will tell you the exact loan amount. Some don't. So if it doesn't tell you the exact loan amount, then, you're just gonna have to have a conversation with your buyer of, okay, how much are you gonna be putting down? Let's say this is a $380,000 home that the buyer is writing on. So in this case, if they're getting a loan for $360,000, they'd be putting $20,000 down. So you just have to make those determinations based on what's in the pre-approval letter or based on your conversation with the buyer. So for this example, my pre-approval letter stated exactly what the loan amount was going to be. So $360,000 for a term of not less than blank years. This is typically always going to be 30 and 30. Term of not less than 30 years, amortized over not less than 30 years. Some buyers will do like a 15-year mortgage, but like I said, 30 is way more common. Then it goes on to say, initial monthly payments of principal and interest shall not exceed blank. So this is where you'll need a calculator because you need to calculate what are those monthly payments. There is a calculator built into Zip form. So you would enter the loan amount here. And I sometimes always screw this up, so we'll see if I can do this, right? Let's say my interest rate is 3.75. The loan term is 360 months. And then it automatically, all I did was I just clicked in this box and it automatically calculated it for me. And then when you click this clipboard, it's going to insert that number directly into the contract. So that's one way you can calculate it. There are also a number of different mortgage calculator apps. I personally like the QL calculator app. I don't know if you can see it right in the middle there. That's the one I like to use. I know Focus Title, their new app, they have a mortgage calculator built in there as well. Just the one thing you want to just be careful of with any calculator you're using is just to be cognizant of the fact that, I'm going to close out of this for just a second, that you're only calculating principal and interest. So if I open up the calculator again, all I did was the principal, which is the loan amount, and the interest. Don't include homeowners insurance or taxes or any other additional expenses. It's just these two amounts.
Kimmy, what does QL stand for?
It's the Quicken Loans.
Quicken Loans, okay.
Quicken Loans calculator.
I was just going to say, I always use the calculator in MLS as well.
I've never used that.
Yeah, because it's on the property itself. So you just click the little tab up by showing time. So I usually do that, but just note, like in here, can we put the interest rate? That one kind of calculates today's rate. So you just want to make sure that it reflects the letter that your buyer got from their lender. And again, the principal and interest amount, because it does calculate the property taxes right into that amount on MLS. So just make sure you're pulling from the right thing and don't make up those numbers. I remember Maureen saying that in one of our trainings, like, you know, when you first started doing contracts, you're like, well, it's about this. It's like, no, there's calculators for that. So just make sure you're filling those out appropriately.
And Catherine, maybe jump in if you have any thoughts on this. I get the question a lot of, okay, if the buyer doesn't know like exactly what their down payment is or what they want to put down, because let me just reference lines 261 to 263. So if the purchase price is modified, the financed amount, so this whole contingency shall be adjusted to the same percentage of the purchase price as in this contingency, and everything is adjusted accordingly. But the question is, okay, what should the buyer put? Is it better to put less down or more down? I would always say to a buyer, like, put down your minimum down payment, knowing that you can always put more down.
Yeah, that's how I've always done it as well.
Yeah.
I mean, unless someone's like adamant about, yes, we're absolutely putting 20% down and that's what they have the money and they're proof of that, and that's fine. I definitely say, okay, like, you qualified for 5% down or 10% down. You can put that in. You can always put more.
Yep, exactly. I mean, the idea behind this whole contingency is that the buyer is protected if they can't get a loan as described here. So if this buyer can't get this loan for $360,000, then they can deliver that letter of unacceptability and be able to walk away from the purchase. Mm-hmm. So that's just what you have to keep in the back of your mind with regards to this contingency.
Can you, back on line 250, can you talk to the loan type specific lender? I mean, I see conventional in there 97% of the time. Do you have that as well?
Yeah, I rarely see like specific lenders inserted in here. Only thing it says in the offer, and I'm trying to find where that is. Basically that the buyer is not obligated to, like, if they can't get a conventional loan from US Bank, they're not obligated to go to a different lender and try to get a loan through a different lender.
Right.
Where does it say that?
I know it's in there.
Well, we'll get to it because it's in here. It's just hidden somewhere. But yeah, buyer doesn't have to go through a certain bank. They also, if they put in here, let's say they're going to get, this is contingent on them getting an FHA loan, but then all of a sudden they want to get a conventional loan, that's totally fine. The words I'm looking for basically say, if buyer, I know where it is. If buyer qualifies, line 271, if buyer qualifies for the loan described in this offer or another loan acceptable to the buyer agrees to deliver to seller a copy of a written loan commitment. Mm-hmm. It doesn't necessarily have to be as it's described here, or it doesn't have to be the loan type described here. What's described here is what protects the buyer in the event they can't get a loan. I mean, they could include a financing contingency and then end up paying all cash for the house if they really wanted to. Mm-hmm. So, all right.
On the other end of that, Kimmy, have you ever seen the financing contingency waived, but then a buyer is still qualifying and just not adding that as part of their contract?
Yes, I have seen that. So I'm going to jump to that.
All right, we'll get to that.
We'll get to the section of if this offer is not contingent on financing.
Yep.
So I'll get to that. The other thing I have seen, though, that may be worth talking about is I have seen buyers who say, okay, this offer is contingent upon a buyer getting a conventional loan, and then they want to switch to an FHA loan. That can cause issues because FHA loans are pretty strict on the appraisal, and it also requires the buyer and seller to sign an additional form that basically says, if this property doesn't appraise, then buyer doesn't have to move forward with the purchase. So the seller essentially almost has to agree if the buyer is going to switch from conventional to FHA. Mm-hmm. Seller needs to be on board with that because they may need to agree to some repairs that wouldn't have otherwise come up. Because they're usually like minor safety things or paint scraping. So switching from conventional to FHA is always a little bit trickier. So just something to keep in mind when writing an offer for a buyer. All right, I'll move on. End of line 253. Buyer acknowledges that the lender's required monthly payments may also include 1/12 of the estimated net annual real estate taxes, hazard insurance premiums, blah, blah, blah. So this is essentially saying that the buyer acknowledges that this is not just going to be their monthly payment. It's going to be this plus some, like with taxes and everything else. This is just the P&I, principal and interest, P&I. The mortgage shall not include a prepayment premium. Buyer agrees to pay discount points in an amount not to exceed blank. Typically, this is 0. If you're in zip form, you got to hit that space key to type in the amount. But if the buyer is getting discount points, it should be on their pre-approval letter. If buyer is using multiple loan sources or obtaining a construction loan or land contract financing, describe at lines in the additional provisions or in a separate attached addendum. This is not very common, so we're not going to get into that, but just come see me if you do have a buyer who's in that situation. Then it goes on to say, buyer agrees to pay all customary loan and closing costs, wire fees, and loan origination fees, to promptly apply for a mortgage loan, and to provide evidence of application promptly upon request of seller. Seller agrees to allow lender's appraiser access to the property. So with this, I want to jump into Addendum A as well. There is some additional language that goes off of this with regards to promptly applying for the loan. So most of the time, you're attaching GMAR Addendum A. Pull that up. So on page 2 of GMAR Addendum A, kind of in the middle, there's this whole financing commitment contingency additional terms. So if you're attaching this addendum to your offers, which like I said, most of the time you are, there's some additional language with regards to buyer obtaining or applying for their loan. So it states within 7 days of acceptance, the buyer shall obtain written confirmation from a financial institution that buyer has applied for financing. The seller may, no earlier than 7 days after acceptance, deliver a written request for written confirmation of application. So the buyer has to be prepared that the seller could say, after 7 days of acceptance, hey, show me proof that you've applied for your loan. If the buyer gets that request, they have 5 days to deliver proof back to the seller that shows we've applied for a loan. It's essentially a letter from the lender that states buyer has applied. So just something to be aware of. I don't see it often, but it's a smart thing to do, especially if you're a listing agent, just to ensure everything is staying on track timing wise, that the buyer isn't dilly-dallying or taking their sweet time on getting their loan application. So the second piece of this is that the buyer agrees to pay any and all costs of obtaining financing. There may be additional costs for the first year premium, for private mortgage insurance, and for property casualty and extended coverage insurance. Flood insurance, if required, may be in addition to the stated monthly payment. Then it goes on to describe what is loan commitment. It's just defined as a commitment from a financial institution authorized to do business in the state of Wisconsin, which does not include a condition requiring the sale of other property. So a loan commitment, if there's a condition in there that says this is subject to buyer closing on this other property, that would not constitute as loan commitment unless they have that closing a buyer's property contingency in the offer. And that buyer acknowledges buyer's obligation to have the total purchase price, including mortgage loan proceeds, available at the time of closing. So just some additional, that the parties may have to wire funds, there may be a fee with that. So just some additional disclosures to the buyer.
I will say on line 64A, I have been on the listing side and have buyer's agents send me the notification that the buyer has applied for the loan without me even asking. So it's probably a good idea just to have that in your dates and deadlines process, to just send it over. I mean, it doesn't hurt, and it kind of helps everyone be aware of what's going on.
That is a good idea.
Yeah, I thought it was great. The times that I saw it on the listing side, I was like,
my process was always after acceptance, I'd take a full copy of the offer and I would deliver a copy of the offer to the lender. So hopefully that's everyone's process as well. And that maybe with that email to the lender, hey, here is the accepted offer. Please deliver back to me, as soon as the buyer have applied for their financing, send me that confirmation just so I have that for my records. It would be a good piece to add to, if I were still selling, I would add that to my checklist of things to do. Okay, so going back to the offer here. All right. Okay, so lines 261, we read through this, that, this would all be adjusted based on the purchase price. So if your purchase price changes, do not need to adjust any of these numbers. It happens automatically. Next, you have to determine whether the buyer is getting fixed rate or adjustable rate financing. So it's one or the other. In this case, this pre-approval letter stated an interest rate of 3.75. So I know it was fixed rate. Fixed rate's going to be the most common. I think I wrote one offer where the buyer did adjustable rate financing. If you do have a buyer who's getting adjustable rate financing, I would just verify with the lender that you have all the numbers accurate. Basically, the way it works is the initial interest rate might be like much lower, let's say like 2%. Then the initial interest rate shall be fixed. So it'll stay at 2% for so many months. And I forget, I feel like it's usually about like 2 years it stays fixed, at which time the interest rate may be increased not more than a certain percentage. So it says 2 if left blank at the first adjustment, and by not more than, let's say 1% at each subsequent adjustment. The maximum interest rate during the mortgage term shall not exceed the initial interest rate plus 6%, let's say. So there are some different adjustments that happen throughout the term of the financing. So just want to, again, verify that with the buyer's lender, so you have that all accurate. All right. Next, we're going to move into the satisfaction of financing commitment contingency. So how does buyer satisfy this contingency? So if the buyer qualifies for the loan, as described here, or another loan acceptable to the buyer agrees to deliver to the seller a copy of a written loan commitment. This contingency shall be satisfied if, after buyer's review, buyer delivers to seller a copy of a written loan commitment, even if subject to conditions, that is either signed by the buyer or accompanied by buyer's written direction for delivery. Delivery of a loan commitment by buyer's lender or a delivery accompanied by a notice of unacceptability shall not satisfy this contingency. So it's only satisfied if that loan commitment is signed by the buyer or there's a separate permission to deliver that loan commitment. I will say easiest way to go about it now that we have the ability to do this is just to have the buyer sign that loan commitment. So the lender is going to deliver that loan commitment to the buyer and or you, buyer's agent. You send it to the buyer to sign, they sign it, and then you can deliver that directly to the listing agent. The key thing here, and again, we talked about this on Tuesday, is this, that it can be subject to conditions. So it can still say that the loan is subject to buyer's verification of employment, or maybe verification that they've purchased home insurance. There's all different sorts of conditions that could be indicated on that loan commitment. So the caution here is that if it does contain conditions, the buyer understands that delivering this letter removes the financing contingency. So if they can't satisfy those conditions, like if they lose their job, then the risk is on the buyer to, the risk is on the buyer. So they could be deemed in default. The seller could, they're no longer protected by this contingency. They could lose their earnest money. A lot of different things could happen. So
oh, sorry. Just so I am clear for everyone on this, and even myself, it doesn't really matter then if there are 0 conditions or 2 pages full of conditions, which I've had both of those actually for buyer's loan commitment, because really this action of delivering the financing contingency is, you know, you're satisfying it, you're removing it at that point.
right.
So I have had agents, you know, if I'm on the buy side and the listing agent is asking for the buyer to remove or satisfy some of those conditions and then kind of, you know, re-deliver. Mm-hmm. I'm just not sure that that's even necessary, right?
Necessary for the...
It wasn't even necessary for the listing agent to ask to have that done. You know, if we had a page list of conditions when we delivered the loan commitment, it really didn't matter at that point because we were basically saying financing is done regardless of how many conditions are on there.
Right.
It was just more to make sure that, you know, some of those things were taken care of, but it's just something to think about, you know, regardless of what's on your commitment, that there could be still things to be done, but that you're kind of saying, you know, we're at a point where we feel comfortable delivering this.
Yeah. So either, because again, once they waive this contingency, I mean, they essentially almost become like quote unquote a cash buyer once this contingency is waived. They either have the funds in the bank or the funds are coming from the lender.
Right.
But the funds are secured is what essentially the buyer is stating by removing this contingency. But they don't need the protection of the contingency anymore.
And that goes back to the point which I've been telling buyers right now, to keep your date on line 251 as close to your closing as possible. Because a lot of people have, you know, they're writing offers now and they're not closing till June. It's like, well, do you really want to give a 30-day financing contingency commitment when you're not closing for another month after that?
Yep.
I kind of wish there was an option to say, you know, within 5 days prior to close on that line, which you could always do, I guess, cross out after acceptance of this offer.
You could.
Keep it as close.
Agents that are starting to get kind of, I had an agent who was kind of trying to get creative with it of, okay, like buyer wants to show that, okay, we've gotten loan commitment, but they also want the protection of what if they lose their job.
Yeah.
Just kind of goes hand in hand with this, but it might look a little different to a seller. Like, okay, we'll have a financing contingency of 30 days, but this offer is also contingent upon, I forget how we worded it, but basically like lender verifying buyer has their job still as of the day of closing. So it basically protected the buyer just for that one condition, that if they lost their job, they would still be protected even after delivering.
Yeah, that's a really good idea for sure. And that language can all be added in. I would just shorten that up and make sure, you know, you usually do write that at 25 days or 28 or 30 days. Just definitely take into account your closing date based on what you're putting in there.
Yep. Yeah. The interesting thing about the financing commitment contingency is, so there is a deadline. So let's say our deadline is 40 days after acceptance. Once that deadline comes, if the deadline comes and goes and nothing, and buyer doesn't do anything, it's not like the offer is automatically null and void. It keeps moving, it keeps progressing. But the seller has the option to terminate the offer. They have the unilateral right to terminate the offer if the buyer does not deliver loan commitment by that deadline. So that is the risk that the buyer takes if they don't feel comfortable delivering loan commitment by that deadline, or they just can't because they don't have it from the bank. So like with any deadline, it's always best to extend via executing an amendment. So you can always extend the financing contingency deadline if A, the buyer doesn't have loan commitment, or B, just doesn't feel comfortable delivering it yet. So that they don't risk seller terminating the offer. And I'm referring here to lines 282 to 284, which talks about seller termination rights. But again, this is where communication between co-brokes is so key too. I just talked to one of our agents who is the listing agent. Buyers did not deliver loan commitment by the deadline. And so we had a conversation about what that all means. And for her and her sellers, it wasn't worth terminating the offer because they knew that they were so close. They were like 4 days or a week from closing. Buyer just needed an extra couple of days. So, in a situation like that, may not need to worry about extending the deadline, knowing that both parties are still on the same page. There's still this mutual agreement, but that communication with the co-broke is key during these times as well.
Can I ask a question?
Yes.
So I'm in the situation right now. I actually have the loan commitment. We just got through inspection. There's a few things that they'd like the sellers to take care of. Nothing that's like a huge defect or anything like that. And then I was advised, my loan commitment, it's not due till May 8th, I think it is. Yeah. But they said, don't deliver that loan commitment, obviously, because we're going to be asking for some concessions for repairs and things like that. So basically that's by not delivering that loan commitment, this is our bargaining tool, kind of, by not waiving the financing contingency. Is that right?
So what do you mean by your bargaining tool?
Well, if we if we would have put in that, given them the letter of the financing commitment letter, we would have been done. We would just been, okay, well, everything's good. Now we're just waiting for closing.
Yeah.
There's no reason the sellers would have to do anything.
As far as giving the buyer like some concessions with regard
for
to the
repairs.
inspection?
Yeah.
Yeah. I mean, I look at I would definitely wait, just because I think it's nice to take each contingency kind of step by step. Like
okay.
they go in an order for a reason. So you're in the inspection contingency period. The buyer is asking for concessions based on repairs that need to be made to the property.
Correct.
It's nothing to do with the financing.
Okay.
Yeah.
I just got the financing letter like just so fast.
Yeah. And even when like we weren't in this circumstances that we are in now, I always waited until like maybe not the deadline, but a day before, 2 days before the loan commitment deadline, just because
it's not due.
Right, exactly. Yeah. The buyer has the time.
On the buy side, there's no need to send that early.
Yeah, there's no good reason. There's no motivation for that.
Right.
No. Keep it.
Yep. And especially at this time, like there's so much uncertainty with everything that's going on. So give your buyer that extra protection of, if something happens, we're still protected by this contingency.
Right. Okay.
If something happens, if it has conditions on it or.
Yeah. Okay. Thanks.
Yeah. Okay. Moving on down to financing commitment unavailability. So if the buyer is not able to obtain financing, so if a financing commitment is not available on the term stated in this offer, and buyer has not already delivered an acceptable loan commitment for other financing to the seller, buyer shall promptly deliver written notice to the seller, including copies of lender's rejection letter or other evidence of unavailability. So if the buyer can't get financing based on the terms in this offer and they need to walk away from the transaction, drafting a notice just stating buyer is unable to obtain financing, and then you have to attach the letter from the lender, that their rejection letter. And then with that, you would typically draft up a cancellation agreement, a mutual release, AKA a CAMR, and indicate that the buyer is going to get their earnest money back, and hopefully then that's all they need to do. All right, we'll move down to page 6, which talks about seller financing. So The new offer separates the self out. The old offer and the condo offer still has this a part of the whole financing contingency. So this was kind of in conjunction with the financing unavailability. So if the buyer couldn't obtain financing, then the seller automatically has the right to finance the transaction if they choose to. But now in the new residential offer, it's a separate provision. So I would say most cases, you're going to want to put NA here. I don't know any buyer that would want, if they can't get a loan from a bank, you know, do they want the seller being their lender essentially? Knowing that the buyer agrees to cooperate with and authorizes the seller to obtain any credit information reasonably appropriate to determine buyer's credit worthiness for seller financing. So I have never even really seen, I've seen sellers explore this option if the buyer couldn't get financing, that, okay, well, we're going to still make you continue with this transaction, even though you can't get financing. We'll look into financing this transaction for you. But ultimately, I've never seen it actually come to fruition. But it certainly could if the buyer checked that box and said that this was a part of the offer. So if the buyer did include this, and the buyer delivered notice of unacceptability, they couldn't get a loan from their bank, the seller would have 10 days to determine if they want to, 10 days from receipt of that notice from the buyer to determine if they want to do seller financing or not. If they do, the offer remains in full force and effect. If they don't, or notice is not timely given, the option for seller to provide financing shall be considered waived.
It's basically like the seller having the right to cure
yeah,
financing.
Mm-hmm.
But yeah, I've never seen
great way
that.
to put it.
Yeah, I've never seen that go into play as well. I've heard it happening out in our office on a like extreme limited basis. So
yeah, I would say this would probably, you know, if the buyer is completely just head over heels in love with this house and can't live without it, then, and they are so desperate if they can't get a loan that they would want the seller to help them if they would willing to, that's when you include it. But I don't know any buyers who have been in that position. So
yeah, and it doesn't mean that the seller is automatically like required to do it just because you're selecting it either. Like that was a question that I got. Like if you're selecting seller financing, does that basically mean like they're committing to doing it? And
right, yeah,
that's not it.
No.
Nor would probably not fly for most people.
Yeah. Yep. All right, moving on to line 298. If this offer is not contingent on financing commitment. So with this piece, either the buyer is totally a cash buyer, so they're not going through a lender, or they still can go through a lender, but they just don't need that protection of the financing commitment. So either they know, like, I have enough funds in the bank that there's going to be no issues with me getting a loan, or in the event I can't get a loan, I still have those funds to pay cash if I need to. I would say a lot of investors I see going that route, so they don't include that financing commitment contingency, yet they still get financing. So if that's the case, or if it's just truly a cash buyer, the default here is 7 days. So within 7 days after acceptance, the buyer agrees to deliver to the seller, essentially what this is saying is proof of funds. So reasonable written verification from a financial institution or third party in control of buyer's funds that buyer has at the time of verification sufficient funds to close, or blank. So the buyer could include some additional type of documentation that they have to deliver to the seller. I will say, I get this question a lot, is what is reasonable written verification? I have seen simply like bank statements showing like I have these funds in my account on this date that exceed the purchase price. I have also seen, which I think is the best type of verification, is a letter from a financial institution, so whether it's a bank or financial advisor, that specifically states this so-and-so buyer has sufficient funds to purchase this property. So it references the property. I mean, I could have $100,000 in my bank account and I could go buy a $100,000 house, but that will deplete my funds. I mean, it's, I think bank statements are not the most, there's not the strongest form of written verification. That makes sense. So ultimately it's kind of, I would say it's up to the seller to determine what is reasonable. Is this reasonable to me? If a bank statement is reasonable to the seller that they feel this is sufficient verification, great. But they may also want to ask for more, or as the seller, you could counter and you could include specifically what you want to receive from the buyer. Lines 302 to 303, you could also, if the buyer is getting funds from a relative, parents, maybe the parents are funding the purchase, you could specify that here as well. Yeah, so if such written verification or documentation is not delivered, the seller has the right to terminate the offer by delivering written notice to the buyer prior to seller's actual receipt of a copy of buyer's written verification. So again, even if the buyer is getting financing, but they don't have a financing commitment contingency, they still have to deliver this proof of funds within 7 days. End of line 305 is where it talks about the buyer getting financing. So the buyer may or may not obtain mortgage financing, but does not need the protection of a financing contingency. Seller agrees to allow buyer's appraiser access to the property for purposes of an appraisal. Buyer understands and agrees that this offer is not subject to the appraisal meeting any particular value unless this offer is subject to an appraisal contingency, nor does the right of access for an appraisal constitute a financing commitment contingency. So very clearly explaining there what all comes into play with not having a financing commitment contingency. Any questions on that? Awesome. All right, we'll move down into the appraisal contingency. If your buyer is getting financing, you're going to want to have an appraisal contingency in here because all lenders are going to do an appraisal. So you want to be able to have that protection for the buyer that they can adjust the purchase price if need be, or walk away from the property if it doesn't appraise and the seller isn't willing to reduce the price. So it states that this offer is contingent upon buyer or buyer's lender having the property appraised at the buyer's expense. So with that, again, if buyer is getting a loan, the buyer's lender is automatically going to hire an appraiser to go out and appraise the property. If it's a cash buyer, the buyer will need to include this contingency. Then the buyer has to hire, an independent appraiser to conduct the appraisal. So at buyer's expense by a Wisconsin licensed or certified independent appraiser who issues an appraisal report dated subsequent to the date stated on line 1 of this offer, indicating an appraised value for the property equal to or greater than the agreed upon purchase price. So if the appraised value is equal to or greater than the agreed upon purchase price, you just move forward. The offer progresses as is, nothing needs to happen. There is no obligation for the buyer to share the appraisal report with the seller. And if anything, you really wouldn't want to. If this is a $380,000 purchase price and the appraisal comes back at $400,000, great, good for the buyer. Don't need to share that with the seller to make them feel like they just got cheated out of $20,000. However, if the property does not appraise, so let's say this purchase price is $380,000, appraisal comes back at $370,000, the buyer will have to deliver a copy of the appraisal report indicating an appraised value that it's not equal to or greater than. Now, there's two different ways to go about this. This kind of works similar to the inspection contingency, now that we have the right to cure with the appraisal. So if the property doesn't appraise, buyer would present that appraisal to the seller as proof that, hey, property didn't appraise. Let's draft an amendment to the offer to purchase, reducing the price to the appraised value. Great. Okay. Of course, then also within this deadline. If it's handled that way by just, hey, okay, property didn't appraise, let's amend the purchase price to $370. This right to cure language just doesn't even come into play. It's just nothing happens with that. The only time this comes into play is if the buyer delivers a notice to the seller stating, hey, property didn't appraise. Here's the appraisal report. If a notice is delivered, then the right to cure is triggered. And whether the seller shall have the right to cure or shall not will indicate what happens next. So again, just like the inspection contingency, always best to try to come to that mutual agreement through an amendment. I would say notice only would be delivered if seller isn't willing to reduce the price and buyer doesn't have any choice but to deliver a notice. Or if we have stated here that the seller shall not have the right to cure and the buyer wants to just make the offer null and void, the buyer delivers a notice to the seller that the property didn't appraise and seller doesn't have right to cure, the offer is automatically null and void. If the seller has the right to cure, then they have an opportunity, we'll say 5 days, to either agree to execute an amendment to reduce the price, or they say, nope, we're not going to reduce the price. And then again, the offer is null and void. Any questions on that? I don't want to read.
That notice, Kimmy, on the right to cure is kind of forcing the seller's hand to go to that adjusted purchase price.
Yeah.
So in your scenario, it was $380. The appraised value comes in at $370. The buyer's agent could go back and say, okay, we're willing to come up, to $375. We'll just do an amendment and be done with negotiating this part. But if the buyer really was not willing to come up any amount above the appraised value, they would just deliver that notice and then kind of give the seller the right to decide what's going to happen. They're going to be willing to go down to the $370 or call the offer null and void.
Yeah. Yeah. It totally depends on the buyer's situation and what they're able to. So like in this example, if purchase price is $380, appraisal is $370, the buyer, like Catherine was just saying, they could say, okay, I'm willing to bring an extra $5,000 to the table to cover that difference. So seller doesn't have to, take a $10,000 cut. Let's meet in the middle. So if that were the case, then yeah, we would execute an amendment acknowledging that, okay, purchase price is now $375. Buyer is working things out with their lender so that the lender knows, okay, I'm going to bring an additional $5,000 to closing to cover that gap.
I mean, it doesn't come up often, but I know it has been happening a little more frequently later. So there is language, and I know, Kimmy, you've probably talked about this on in your office or added that language, but you can kind of handle this on both sides, either as the buyer's agent or on the listing side, if you want to kind of have that upfront outcome protection basically on what will happen. Let's say you are $10,000. Like, is the buyer willing to come up to, like, are they willing to really purchase that property at the $380 if that's what they're offering at? Or on the sell side, if you're the listing agent, you can also counter language in to say the buyer will, if the appraised value comes in lower, will bring that extra money to close.
I see that a lot when buyers are writing like well over asking.
Yeah, especially in competing offers and escalation clauses, and it's come up for sure more often.
And so that's always something to be cognizant of as a listing agent, right? So don't get your seller excited about an offer that's $40,000 over asking, because if there's an appraisal contingency, you're going to run into a roadblock unless, or I should say, you're going to run into a roadblock if it doesn't appraise, unless buyer has agreed up front, hey, I'm willing to pay, I'm willing to, you know, fork over additional money should this property not appraise. The other thing to be cognizant of as a listing agent with regards to the appraisal contingency is meet the appraiser at the house, or in the times we're in now, have a phone call with the appraiser or email the appraiser copies of your comps. What comps did you use to come up with the list price of the house? I will say more often than not, anytime a property doesn't appraise and I ask the question, did the listing agent meet the appraiser at the house? They say no. And not that that's always the case, but it certainly helps when an appraiser sees, you know, the 3 or 4 listings that helped you determine the list price of 380, you know, they're more than likely going to use those comps to in their appraisal report. So that always helps. Never seen it hurt.
Yeah, if I can't get out to the property, I will email the appraiser, because if you're the listing agent, they're always going to schedule that appraisal with you. So you have their name, you have their contact information. So at minimum, I always send over a packet, how many offers I received, how many showings happened in the first few days, because that's the anecdotal information that they don't get. They can pull, you know, they might, I've heard some of them get a little, you know, perstickety if you're providing comps and they're like, well, yeah, I can do that too. I haven't personally had that happen. I've just heard stories about that. I've never had an appraiser have an issue with either A, me being there, or B, providing information to them. I think it helps tremendously. Yeah. So, and you're protecting your seller.
Like,
so
I think the key is like keeping the interaction very like brief and here you go, sir, ma'am, here are the comps. And I would write notes on them too, like, okay, this one is good comparison because of this or not because of this, and just give it to them and then let them do their thing. I don't like follow them around the house or make them, you don't want to piss them off or annoy them, but just
but definitely the activity of what happened within the first few days of being on the market helps, because they don't know how many, you know, you had 40 showings in 4 days. They won't be able to receive that. So definitely important. I will say last year was the first time I always on the buy side, of course, if they're financing the transaction, I have an appraisal contingency added into my contracts. Last year was the first time that the lender did not need it, which I'd never had that happen before, but they told the lender based on comps in the neighborhood that sold, they were well within their threshold of not needing one. They could basically say, here's the value, and buyer, would you still like that appraisal done on the property? And the buyers decided to just waive that because, you know, they saved the $300-400 that it costs to do the appraisal, and they felt good in the value. So that was literally the only time I ever had that happen. Hasn't happened since, but it did happen to me one time where the lender was able to waive it.
And it certainly makes the buyer's offer stronger. I mean, the least amount of contingencies a buyer has in the offer, the stronger the offer is. So if a buyer can be in a position where they don't need to include that, that's great.
Yeah, I mean, we included it because it didn't come up until a little bit later. So yeah, it would have been good to know upfront, but we didn't end up needing one, which was very interesting. And it wasn't like we got, you know, an outstanding quote unquote deal by any means. It was pretty standard offer, but they must have had some pretty strong properties in the very specific subdivision that they were buying and that they didn't need it. So
it's awesome. All right. Well, that's all I have with regards to the financing and appraisal contingency. Any other questions from our audience members?
I do have one more
Yes, please.
comment. It's kind of a question / comment for you. Let's say your buyer does not want the appraisal contingency, kind of similar to how like a radon test works. You know, you don't need the radon test to be done in the house. And then your buyers ask you, well, we're not asking for the seller to do it, but can we have it? And you're like, absolutely not. You can't have a test done in the house just based on even your own knowledge. It would have to be as part of your offer. So can a buyer have an appraisal? I think I know the answer to this, but I'm kind of just saying it out loud. Can the buyer have an appraisal
without an appraisal contingency?
Exactly.
That's a good question. The answer is yes, just because like, I mean, I would be shocked if it was no. I feel like it states somewhere in I know it states if the buyer isn't getting financing that the seller agrees to allow the buyer's appraiser.
Yeah, it's actually in the financing section. So I think the answer is yes as well, but you know, it doesn't say like if you don't have an appraisal contingency, you're not going to let an appraiser even access the home. But it does say on line 280, seller agrees to lender's appraisal access to the property. So that's in your financing commitment, regardless of if you're kind of putting it as part of your transaction.
Right. So I think
my answer and kind of the
yeah. So the answer is yes, and I think the the way to look at it is no, the buyer is just not protected by the appraisal piece. So let's say in this case, appraises at 370. Lender has looked at buyer's finances and has determined, well, you could put, I don't know, maybe more down. Like we can't. Maybe we will still issue you loan commitment based on a different loan amount or something to cover, so that piece of that missing piece of the appraisal is covered. Maybe I'm not explaining myself.
Yeah, I know what you mean.
Well, but so that the buyer's just not protected by just the appraisal piece. They potentially could still be protected if they can't bring that extra funds to the table to make up the difference.
True. Yeah, they're
all protected by their financing, but
yeah, but their financing is for that particular amount. Let's say they can't qualify, you know, they're bringing 5% or 5% down and they can't come up with the additional funds. They're really protected under that. That goes back to the whole, how much would you put in there for the loan value? So
yeah. Yep. Awesome.
Cool.
All right. Well, thanks for joining us today. I've got one chat here. You're welcome. All right, guys, stay safe. We'll see you next week.
Thank you.
Thank you.